What if you could unlock the secret playbook of venture capital that most investors never see? In the next 60 minutes, a Wall Street mathematician turned global investor will reveal how to build wealth, navigate emerging markets, and transform capital into a meaningful impact, all without playing by the traditional rules. See, this isn't just another investment podcast. This is your blueprint for making billions while changing the world. All this and more coming right now. Here we go. Welcome to the show.
Thank you, Ryan. It's so good to be with you here on Making Billions. I'm a big fan of the show and particularly a fan of your relational approach to telling stories of others and being so authentic. Thank you for that.
Brilliant. And we're going to be telling your story today, but not just a story. It's more about the things that you've achieved because you've done a lot. As soon as you told me about your math career, I kind of geeked out a little bit. I was like, you got to meet my daughter. But with that, let's jump right in. You've done a lot of things throughout your career, but one of the things that we do on Making Billions, especially, is we want to know how to win, how to get early points on the board. So I'm just curious, from your experience and everything you've done at Beyond, how would you say people get early points on the board when building a career in high finance?
Yeah. So there are a couple areas. I mean, the first really is to have a differentiated investment strategy. What that means is that you are sourcing better or sourcing more differentiated deal flow, unique deal flow, deal flow that others can't find. You're investing better. So the actual action and execution of your investments is superior for one reason or another. I don't want to say better because it's a generic term, but superior meaning you are doing something different to produce better results. And then the third is that you're managing your portfolio better, or you're just simply adding value to that portfolio so that you drive towards exits. That's kind of a cheat sheet to having a differentiated strategy. And I think is one like oversimplified way that investors sometimes get lost when it comes to like, what actually are they bringing to the table? The second area is understanding that in reality, what you're selling is a track record. And for many reasons, people are investing in your track record. So developing a track record is absolutely paramount. While that means that there could be a kind of a mindset of exits starting from day one, I think what's really important is making sure that you understand what exits look like from day one. So it doesn't have to, be like, I give you the money, Ryan, and you do what I say, and you produce an exit, and you figure out what that is. I actually come into the deal knowing how I think the exit will occur. And that sounds like it's table stakes, but for us, exit modeling is a really important part of our investment process. And I know for others, it isn't actually a part of the process. They're looking at an idea, they're looking at a team, they're looking at potentially a company within a sector that they think will have a rising tides lifting all ships effect. They may not always be thinking about the exit, but we want to know specifically how that is going to happen. And so due diligence is really important for us and also in this how. And then, I think generally being a good person, I'll add that in there, is a really important way to win. I mentioned that I really love the relational approach to the way that you prepare for this show, the conversations that you bring forth. You almost tease the best out of your guests here. And why that matters is because you're using relational over transactional. And that is absolutely a winning investment strategy as well.
Oh, brilliantly said. And maybe it's because you were so kind, but no, in all seriousness, thank you. That was very kind. And, for those who have been listening to the show, Eva, a lot, and I know you're one of them. And one of the frameworks that I put out there, and people often ask about, different strategies in raising capital. And I said, the three most valuable assets in your possession are your reputation, your relationships, and your results. And you just hit on all three. And I don't know if we've even spoken about that framework. And I teach a lot of people who ask like, hey, I want to launch a fund or flip a few houses, whatever it is, they want to do deals. And that summarizes what we call long game strategy. Is to say, you're not going to build reputation, relationships, and results overnight, but you do need to build reputation, relationships, and results. And a story that I'll tell, I haven't said this live. So recently I was on a road show. And for those, if you know what those are like. And I was very fortunate. So I flew into Dallas and I was around the table of about 9 guys. And from the best I could calculate, they collectively controlled about $500 billion and they all came to see me. Maybe it was for the steak dinner. I don't know. But either way, they were around the table. And I talked to they were all such brilliant guys. Some of them owned investment banks. Like these were really, really cool guys, down to their core, amazing human beings. And it really resonated when we were having a discussion about finance, exactly what you talked about, Eva. And we said, and I remember telling them, and they were like, that's it. And so it's that moment. I call it the meeting of the nine. All eyes are on me, and we're talking about high finance in more of a philosophical way. I get that way sometimes. And we talked about, if you think that finance is about transactions, you've missed the point. It's about trust and funds, or whatever vehicle you do. It can be a fund or whatever deal. That's just how you move those trusting relationships, your reputation, all of that. You move it through those fund vehicles. And so if you just want to build the structure, you can. Anyone can. Call your lawyer, spend $150,000, set up your own fund, do whatever you think, right? Talk to your attorney. But at the end of the day, if you try to do that without establishing a reputation or relationships or results, right? Everything you just said, it's going to be really hard, really hard. But there are ways that you can go about it. But I don't think there's any shortcuts to what you said. And so just between you and I and anyone else listening, because we've never discussed this before, but you can see that when you're in the game, we all arrive at the same place with experience, is to say, sure, you can go to school and learn how to do the transactions and due diligence and the math, which you did. But I think it's important to keep the main thing. And the North Star is what I call the R3, is reputation, relationships, and results. And make sure that how you conduct your business, that the way you conduct your business is like investing in those assets. And over time, they become more valuable and you can do more good in the world with your fund. Is there anything else that you can add to that?
Well, I think there's a little bit of an abundance mindset that's required to play the long game. And I mean, I think one way, like you said, how to win, but like one way, like not to lose, is to be on top of your mental game. And if you're not organized, or you don't have the right support around you, or you don't really believe that it's going to work out when you're playing the long game, you're often not able to play the long game. You're constantly thinking, when is the shoe going to drop? This is not working out. And I'm never going to make money with this strategy. And so I would add that it does require a little bit of personal work to stay in the long game, to be able to command a room of serious wealth and pitch an idea is energetic. And that work is sometimes more personal than it is professional. And what I mean by that is I'm lucky enough to have worked with an executive coach, Karen Eldad, for it's 2025. So now for 8 years on and off. I've done other things that have really helped me stay what I call above the line, relational abundance mindset, and able to see possibility as well. Because if I was transactional, short-term focused, and more kind of focused on me, when I win, you lose, which is what we call below the line at our firm, then my results actually won't be the same. I won't go the extra mile that's required.
So that reminds me of a framework called the UVE framework. It stands for umpires, vampires, and empires. And umpires are those people that keep you on the straight and narrow, right? They call it, even when maybe you're clouded, you're busy and not thinking straight. Hopefully that doesn't happen. But if it does, those are the people in your life that you need. You need those people. And it could be people that have an amazing marriage and maybe yours is struggling. And they're like, don't do that, do this, right? Or maybe you have a legal question and you have great attorneys or accountants on your side, or just good friends, for heaven's sakes, or other professionals, executive coaches. All of them matter. You need those umpires in your life that will not let you take this crazy train we call life off the rails. Vampires, same thing, or same fashion. These are people, but most likely your own habits, your own crappy perspectives, your fractured realities that you have, these time wasters, these things that just drain your energy. Most of them are self-inflicted, because when we think energy vampire, we think someone else, right? We couldn't be doing it to ourselves, of course. And then finally, empires. These are people who think big, just hanging out with them. They're building their own empire. That's a little dramatic spin, but these are people who are in the game as well. And having those people around you to say, have you ever considered this? Or, you know what? I did a deal last year with this person who would be perfect for you and what you're trying to do. And these people that are builders, they're about the process. They have big vision. You need people like that around you to stay that. And guess what? They probably need you as well. And so having that energetic is getting your energy right. Then when you're in a good state, and we've all met those people who are just like, they're infectious. They're so good. you just get pumped up and you're so happy to be around these people. We need more of those in our life. And when you do that, imagine you being that person in a pitch, or you being that person with that kind of energy, because you've stood on guard. You're the sentinel of the sanctuary, and you've now stood on guard of your own mind and life, and you've structured in a way to be wildly energetic, and you bring that into everything. How cool is that? So when I figured that out, what a difference that made. And the final thing I'll close on this thought is I had a good friend of mine, Ben Reinberg. He just recently released his book. He managed about 500 million, and a wonderful human being. And he always says this to his energy, is he says, always ask yourself the question, who do I want in my green room and who do I want in my boardroom? And he said, that's more of a people focused thing, but no less profound. And so green room, if you've ever spoken on stage, you got your posse, they show up, they're pumping you up, and you feel like you're ready to run through a brick wall before you go on stage. You want people like that. Those cheerleaders, those people that stand up and clap when you win. And then you want people in your boardroom. So those would be your empire builders. And so if I'm saying anything at all, if I'm connecting with what you're saying, it's really saying, you know what, sure, we'll talk about transactions, but what about all the prep work that goes in front of that, behind the scenes? And a lot of that comes down to energy. And so if we want to transact, because if you're raising capital or doing deals, guess what? All that money that's going to be in your fund, it's sitting in someone else's account. And there needs to be an energetic exchange for that to happen. And so keeping yourself in check and being that professional and optimizing your energy, that is one of the best ways we could do to really enjoy our pursuit of making billions. So I absolutely love that. I geeked out pretty hard on that because you're speaking some real truth. You really are. Now, I'd love to we talked about track records, being exit ready and exit due diligence. You mentioned that. So that's really good. That's really good, right? Get some early points on the board and then focus on your results, right? From day one, to say, how do we want this to go full circle? But that's not enough to look at the upside. There's downside as well. So from all of your perspective, all of your experience, and all the cool stuff that you've done, what would you say are some helpful pieces of advice on how not to lose in fund management?
Yeah. Well, number one is what I call trust but verify. So if I'm thinking in this UVE framework, it is kind of employing more of an umpires type mindset. So, I'm an empire builder too, like you, and I see the big vision, but I know that umpires are required as a part of that strategy. So trust but verify is kind of our firm motto, which is really verifying the claims in due diligence. So, you hear a pitch, you're told, here's the total addressable market, here's the countries that we're going to expand into. If it's in Africa for us, because we do have companies that expand across the African continent. If it's India, here are the new markets that we're expanding into and why, or here are the new business lines that we see being attractive for the next 5 years of the company. And we need to verify all of this through our due diligence, whether it's verifying that the market exists, whether it's verifying that the company has the right connections or it is not too expensive for them to do that. That is, a basic rule, but something that I think is really important, particularly if you're not employing a power law investment strategy like we are. We are not at Beyond Capital Ventures. And what that means is power law would be kind of a portfolio of 10 investments where you have one, 10 to 100x, and the rest of them are kind of singles and doubles and maybe even losses to make up for the winner makes up for all of the losses. And so we are more of a kind of, I would say, like an investor that's focused on having returns more narrowly around a specific band and having less losses in the portfolio. And therefore verifying assumptions is super critical. The second area I think that's quite undervalued, interestingly, in the fund industry is knowing how to run a fund business. It's running a fund is a business in and of itself. And I find myself chuckling when I have to explain that to founders who, ask for an extension on a loan because we have a credit fund, or, make a late payment, which doesn't happen very often, but occasionally happens, and then don't want to pay the late payment fee. And I have to explain, we're in the business of investing people's money, and that is an actual business. So it's important to know what it takes to launch a fund. It's important, launching one, I think you said, just, go put down the money and launch it earlier in this conversation. But running one is very complex. If you don't want to run basically two businesses, the business of investing and the business of keeping the lights on at your fund from a compliance perspective, from a financial perspective, from a reporting perspective to your LPs, from an investor relations perspective, then do not launch a fund because there is a lot that is required, including the third job of raising money, which I am comfortable with and happy to do when I'm in empire building mode. But that can sometimes be 50% of your job as a fund manager, depending on where you are in your fundraising cycle.
You bring up a good point. As I jokingly say about raising capital, I was like, well, without capital, it's just a bunch of smart people having coffee over Zoom. You're like, what are we doing here? Like, someone's got to put the money in the deal, or we're just going to keep talking about deals. But you got to do them, which goes back to the third R of results. In a joke, and I've said it on the show before, running a fund and launching a fund is like having a wedding, and running a fund is like having a marriage. Although those two sound similar, they're very different skill sets. I'm like, anyone can get married, but to stay married is different. Anyone can launch a fund, but to run one and to do everything that you talked about, and you just highlighted the top line stuff. It's tons, and you obviously know that. It's a lot of work. And so launching a fund, depending on where you're at, obviously we're not attorneys, but check with them if that's what you're thinking about doing. But really, I think the message of what you're saying, even keep me honest, is to say, really understand what you're getting yourself into, whether it's a fund structure, syndication structure, tax regimes, due diligence, investing, raising capital. Is just the spirit of everything that you're saying, where it all converges, is to say, make sure you really, really know what you're getting yourself involved in. And if you do, you're going to have a great career. If you don't, there might be some surprises. And ironically, investors don't like to be surprised. Who knew?
Yes.
They're like, what? You didn't tell me that, or whatever that is. And so, as they say, I believe in the Navy SEALs, is slow is smooth and smooth is fast,
Smooth
or
is
something
fast.
like that. Yes. And so seek smoothness, not putting fund manager in your LinkedIn title and making mom proud, although that's good. We got to make mom proud. But the thing is beyond titles, beyond social media, beyond all that stuff that maybe people feel like they need to do, the important thing is just really understand what you're getting into. And it's okay to be in a process and work your way up to excellence. So that being said, I love it. Any other pointers as far as how not to lose in this industry?
Yeah, I would kind of echo and extend on what I said before about doing the personal work. I think the other way to not lose is to know what are the other tools aside from financial analysis, market analysis, team analysis, reference checks, the low-hanging fruit stuff. What else will give you an edge? And I really believe that for us, the edge is being very founder focused, being what we call founder fair rather than founder friendly, and understanding who our founders are from multiple perspectives. So we not only get to know their style of running their business through due diligence, but we also do psychometrics on our founders and on our team using the DISC framework, the DISC framework, to get this kind of mental map to know how to add value post-investment. We don't use it for investment decision-making, but it allows us to know what motivates each founder and potentially which relationship manager we should partner with that founder for our portfolio management approach post-investment. And then one other area that is really key for us is we talk about a framework called conscious leadership. John Mackey, who started Whole Foods, wrote a book about this. It's really leaders who consider all stakeholders as critical to their business success. And I had somebody ask me, what does that really mean? And the answer is simply put, I just want to make sure that this founder has the skills to be able to get the job done. And we evaluate how founders are, behaving in frameworks like UVE, like your energetic framework, like what are they doing to up-level themselves, to call themselves to higher leadership? But we also help understand, like, who else could be a stakeholder that could come in and make your business difficult? Like, perfect example, you said flipping houses. Like, if you can't get the permit, you can't flip the house. And that's just what this comes down to. So you should be thinking about the government as your stakeholder, because otherwise it's a bad investment for me.
Brilliant. That's, I don't know if anyone calls it this, but you're hitting on something very brilliant. And I think it's up to us as kind of the up and comers, or, I don't know if we're that new to it, but just the next generation in we'll say generally capitalism, Capitalism 2.0, I think, is moving away from shareholder focus to stakeholder focus. You're spot on that, is to say, yeah, obviously it's broader. It's not one or the other. We're saying, yeah, obviously we take care of our investors, our shareholders, people that have an equity interest in what we do. But there's also stakeholders. There's employees. There's government. There's all kinds of things. And when you broaden that scope, and those are also, because I spent some time early in my career in oil and gas, and I can promise you, at least the place I worked at, it's a wonderful place called Suncor Energy. And they really looked at Aboriginal rights and protecting the land and honoring the fact that they had treaty agreements. And they really said they're stakeholders. They're not shareholders in our company, but they are stakeholders. And how we utilize the land, it matters. And so taking that holistic view from all things, not only is it like, oh, that's nice. Yes, please do that. But also it hits right at the core what you said, is say, but we need to make sure that we've considered all things, because at the end of the day, we need results. And we have to make sure that the person we're backing, not just the company, but the person, has the emotional and mental mettle that they need to get it done. Because guess what? As professional investors, that's our job. People are trusting us with their capital. And so we have to do it, because that's why they give it to us. If they were going to do it, they wouldn't need us. So it's our job to look around corners and really do that due diligence. And you do it masterfully, both from not only running the company, but also through mathematics. I can't wait to get into that too as well. So I love it. And like we say, I summarize it, success is an inside job. And so making sure that those things, and so taking the DISC framework, understanding who are the people that I'm potentially going to be locked with for 5 to 10 years. Who are these people? And is this a good fit? At the end of the day, to say what's going on the inside, because if we want to be successful, we can't ignore that. So anything else you can add to that?
I just think I need to get the tattoo that says success is an inside job. That's so great.
On your forehead, please. Yeah, no, I'm teasing it, but yeah, it really is. So I actually do have that. That was something I came up with when I was much younger and maybe filled with more dreams than results. But I was like, you know what? If I'm going to achieve what I set out to, it comes from the inside out. So love it. You're starting to get it. Energy. Yeah. So there's a framework shaping up here, I think. So now, we wouldn't be a show called Making Billions if we didn't talk about the market, right? So the one and only. So there's many markets, but you're paying attention to, I know you invest not necessarily in America, but your focus is on the other side of the planet. So I'm curious, what are you seeing in the market right now? What's getting your blood either boiling or smooth sailing? What are you seeing right now?
Yeah, I'm seeing an incredibly large, growing next wave of consumers who have been left out because investors don't know how to access their markets. So it's not intentionally left out. They've just been left out. There's not the level of healthcare or health tech or fintech or ag tech or mobility that we have in, I'll call it the West, just to be convenient, but the US and Canada and Europe, it's just not the same availability. I think I've said earlier today, like the beauty about me being American is like you have the paradox of choice. You can actually express your values through all of your investment decisions or all of your spending decisions because you have 10 different yogurts that you can buy in the supermarket, probably more than that. And so why I'm so bullish on emerging markets is because so many things have not been built yet. There's a lot of consumers that are demanding access to need-to-haves. 53% of the world's growth will occur in the next 10 years in the two markets where we invest, India and Africa. And there is lacking access to basic goods and services where there's a market opportunity to make money. And so what I'm seeing is the future of global growth. That's where I get to invest. It's why I get up every day. And it's why I believe other investors should pay more attention to what is happening outside of the US. And I think the beautiful tool of capitalism, which is elegant and never perfect because nothing is perfect, but provides just the right amount of incentive for founders and to build and innovate so that they can, create generational wealth, but create solutions that really meet their markets is the way that we are capturing this at Beyond Capital Ventures. So that's our focus, is investing in the future of global growth in two of these largest markets.
Yeah, India and East Africa is the
Correct.
Focus. Oh, love it. I wouldn't call myself an expert, but more of an enthusiast. But I could say I always looked at those two areas and just intuitively, like you're following the numbers, especially Africa, just generally speaking, that continent. And I was like, man, it just seems like that is so untapped for some reason. The little I can tell, and maybe I'm wrong, right? I don't claim to be an expert on that continent, but it just seems like there's so much potential. I mean, they've got every geography you can think of, right? So you can do agriculture, mining, finance. There's so many things out there that's just untapped. And I don't mean that like rub your hands together like a greedy POS. What I'm saying is maybe there's opportunity to help people rise. And for those who have listened to the show, you know, my mission since I was a young guy growing up in the hood was to say, I'm going to make it out. And I've dubbed it the rise of the rest. And that has always been my life mission, is to say, how can I fulfill that mission? And so thank you for doing that. Maybe you didn't know that, but I really want to appreciate that you not only are smart in business where you can see the opportunity because that's what people are trusting you to do, but also in the place to say, you know what, I'm going to take a shot. I'm going to take a shot in these places instead of stick to the trusty old America strong capital markets. That's great too. But I think what you're doing is absolutely brilliant, and you're facilitating in the rise of the rest. So I commend you for your efforts and everything you've done. Now, stepping out of sentiment, it's one thing to say, this is what I'm seeing. It's another to say, but where do you see it going? So let's use your math brain and extrapolate moving forward. We're talking about the future now. Where do you see the future holds for what you're doing?
Yeah. Well, what's great, I mean, you kind of pointed out there's a win-win opportunity. And for us, the win-win opportunity creates a track record. And the track record helps us raise more funding later on. And so just to be concrete, what we do at Beyond Capital Ventures is we have a venture fund or multiple venture funds. We have a venture arm where we invest seed to Series A plus, and we do that into businesses in the sectors I mentioned before. So need to haves. And we also have a credit strategy, and we close that on June 30th. And so we are able to make loans to our venture fund portfolio companies, and we're building a track record. So where do we go as a firm? We continue to pick quality companies, and we continue to back them both with equity and debt, which I know is somewhat unique in the capital market spectrum, but there isn't much credit available. So we're able to make that work. We have the right conflict committees in place and things like that. I'll give you an example though, because I think it'll really help you understand where things are going.
Please.
We're invested in East Africa's leading e-mobility business. So when you think e-mobility, you think Tesla, you think four-wheelers, you think Cybertrucks, you think Waymo, all the electric cars. The reality is people in emerging markets are typically getting around using two-wheelers and sometimes three-wheelers and sometimes very small four-wheelers. But we are invested in East Africa's leading two-wheeler e-mobility business called Ampersand. And this company, its entire focus was initially building the bike. So they figured out how to build the bike, and then they went on to the next piece, which is almost more critical if you know about mobility, the battery. They started to create their own battery technology, understand, how to optimize batteries, understand battery life, where batteries are, using it as a tracking mechanism because the rider owns the bike, but they own the battery. And then they realized that your average African does not have a plug in his or her wall, and therefore they can't charge their bike at night when they go home after they deliver Uber Eats or take people around the city in a ride share. They need a battery swap network. And this company moved on to setting up East Africa's first battery swap network in collaboration with a very large French energy company that has allowed them to put the battery swap stations in petrol stations and gas stations so that there's absolutely no behavior change. And I think what's fascinating about the arc of this business is that it started out with a product and it moved on to become an infrastructure play. And that's the type of evolution that we are seeing in our portfolio companies. Companies starting out with something simple and moving on to a much bigger vision. And there are many different directions that this company can go, but I think serves as like the perfect example of where Africa is going. And now this company has more than half of its revenue coming from battery swaps rather than bike sales, because other OEMs, other bike manufacturers are plugging into that network as well.
Brilliant. There's so much promise in that region of the world and everywhere, but I know it's we'll say the flavor of promise on that looking forward. There's so much opportunity, and thank you for being the trailblazer in that area. I'm sure a lot of your founders invested in are pretty grateful. So that being said, as we round through base, I'm just curious, one of the things we take I really take joy in is providing people with deep competitive advantages. And you didn't get this far by accident. As they say, the person at the top of the mountain didn't fall there. And so there's a lot of experience. And so I'm wondering if you had, say, 2 or 3 deep competitive advantages that you can provide for our listeners.
Absolutely. The first is understand risk. I really believe that in this environment, we were in a risk-on environment when I worked in the fund of hedge funds business. I watched Lehman fall, Lehman go bankrupt right in front of my eyes on the Bloomberg terminal. It's a moment in life that I'll never forget, the flashing red in all caps on the screen. That was also a risk-on environment. And I think understanding what that means is critical to being a good investor. And so if I were to select a manager in my own portfolio, I would make sure that they had experience in the last market cycle or a financial advisor. I think that's what does risk actually mean for your investment cycle? So perfect example, let's continue the house flipping, which is something I've done in the past on the side just for fun. Yeah. And certainly think about doing it all the time if I had spare time in my life. But if you can't get the permit, you can't flip the house. If the market drops because there's an issue with credit availability or pricing in the market or a supply demand imbalance, you can't flip the house. So I think these are important things to understand is where are we in a market cycle? The second area is to really just be a good portfolio manager. Don't just sit on a board and dial into the meeting and do other work and stay off camera. Be on camera. Are you being a U, V, or E? Are you being an umpire? Are you being a vampire? Or are you helping build an empire? That is really important when being a portfolio manager, providing value to your companies and being what we call founder fair. I'm not sure founder friendly really is a real thing. And that's why founder fair is the term that we really prefer. So be influential in ways that strengthen relationships. And then the final point is think about a mechanism to find a real win-win. At Beyond Capital Ventures, that means that we are bold enough to give a percentage of the general partner profit share, the carry in this fund, in our funds, to all the founders.
Very
and
generous.
That win-win means that our founders are more willing to work together. They're more willing to give us good deal flow. They're more willing to pick up the phone when we call. They understand our portfolio and our investment strategy probably better than other organizations because it's not just a check for them. It's a carry stake. It's something meaningful. And I think that that's something that more VCs could be a little bit more innovative about their structures and how they actually do business and share value with their portfolio companies. And the final thing is understand that managing people's money is a privilege. Yeah. That's super critical for me, and is really one of the areas where I think I'm deeply competitive. I'm deeply kind of have a competitive advantage. Is that we are great communicators at my firm. We always pick up the phone. We always answer the questions in a timely way. No stone is left unturned, and it's not a burden. I don't see it as a burden when an investor asks questions. And I don't understand when other investors, roll their eyes at somebody saying, hey, can you explain that to me?
Brilliant. You remind me, a friend of mine who started as a guest, his name was Michael Episcope. He was the trader of the year in the CME for 1 year. And he switched to real estate, and he said, I didn't want to be known as the guy who used to be rich. So he switched to real estate. But one of the things he talks about in his firm is he said, to complement your point, is to really triangulate for our audience to say professional managers like you and many others, they have a very strong communication policy. Notice I said successful managers. And so one of the policies he taught me, and I've implemented it as well, and what I do is to say, we walk out good news, we run out bad news. And I was like, damn, they may not love the words coming out of your mouth, like, hey, the deal went whatever, but they will always respect and trust. And remember, finance is more about trust than transactions. And so maintaining that trust, even if it's bad news, it doesn't mean your LPs are going to leave. But it's a moment where that is where you are introduced to the foundational culture of your investment firm or fund or whatever it is you're running, is to say, when things go south, how do we handle that? And job number one is to say, complement exactly what you said, is managing other people's money is a privilege. And people to remember that, I think it leads you to, hey, I'm managing your money. You need to understand what's going on. The deal went the way it went, whether it's good or bad, but either way, whether you like what I have to say or not is irrelevant if you don't trust it. And so above all things, that trust coming out of your mouth, that is the key part, and being really good at communicating. And you're a pro. We can obviously tell we're having a great conversation. So I love that. Now, before we wrap things up, this has been absolutely brilliant. You're brilliant. This is amazing. And I'm looking forward. I can be maybe the umpire in Empire for you. I'll applaud you from Canada and we'll sit on the sidelines and watch you your star continue to rise. Before we wrap things up though, Eva, is there any other final comments, any ways that people, if they want to learn more about Beyond or you, or how do people dive into your orbit a little bit more if they're looking for it?
Yeah. Well, you can find my firm and me on LinkedIn, kind of from more of a professional perspective. You can also learn more about a book that I wrote called The Good Your Money Can Do at thegoodyourmoneycando.com, because the reality is we can all line up our values with our resources. And that's a really powerful, energetic thing to do. It helps you get up in the morning when your alarm clock goes off too early.
Yeah.
Or your kids are waking you up. Yeah. And so those are the two main ways is, learn about our portfolio, learn a little bit more about what it means to think about investing from a different way, but in a way that brings an edge to the table. I mean, that's what everybody's looking for is what is my edge? And so what we communicate through LinkedIn and through our website as a firm, which is obviously available through LinkedIn, is how we do just that and why that matters. And then I do have a 4-season podcast if you're interested to listen to interviews with purpose-driven leaders, and that's called the Beyond Capital Podcast, and you can find it on all of the podcast channels. And that's a really fun show where we get to understand what really drives purpose-driven leaders, what keeps them glued to their whys.
Brilliant. I love that. Totally resonates. So you can see there's a lot of depth that you can dive into a lot more. So just to summarize everything we talked about, just be willing to give a % of the GP carry to some of the founders. If jumping in with both feet and you're jumping into venture capital, that's considerable as far as a strategy goes to create alignment and win-win for all parties. And you know what? That also enhances your reputation, relationships, and your results. And another one is understanding risk. Make sure you understand the downside. When I graduated grad school, my wife asked me, did you learn anything different from undergrad to master's? And I said, maybe one thing. And that was grad school teaches you a lot about risk and covering your downside and anticipating it. And so that is a really, really important part. Thank you for saying that. And then finally, just get good at being a portfolio manager, and not necessarily, you don't always have to launch a fund. It's a good vehicle in the right scenario, and it's a horrible vehicle in the wrong scenario. So really understand what you're getting yourself into. You do these things and you too will be well on your way in your pursuit of making billions.